Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi, this is Yazad. Looking to invest in the next Amazon, Titan or Bajaj Finserv? Then you should definitely explore your options in small cap stocks. Now you might ask, why are small cap stocks a good investment? Historically, small cap stocks have outperformed during times of economic recovery. This is playing out now as the economy is currently in a revival mode and the full value chain across sectors, including small cap companies, is expected to benefit. Small cap stocks have been known to generate over 100 times returns on their original value in some cases. Investors with an appetite to take on some high risk and looking to make multi-bagger returns may consider investments in small cap stocks. So can 2022 be the year where you focus on building your portfolio of small cap stocks? Well, possibly yes. To put things into perspective, there are over 4,500 small cap stocks listed on the Indian Stock Exchange. If some of them are undervalued, then this is just the icing on the cake. In last week's video, we looked at 5 undervalued mid-cap stocks that you could track. If you missed that video, you can click on the link below and watch that as well. And a lot of people were interested in knowing if we could put out a list of undervalued small cap stocks as well. So continuing with the series, here is a list of the top 5 undervalued small cap stocks that you should add to your watch list. First up on our list, we have Den Networks Limited. Good news awaits if you are looking to invest in the media and entertainment segment, as a strong revival is in the offing in the financial year 2022. Some of the key factors that are propelling the growth are favorable regulations, technological innovations, and emerging investment opportunities in the broadcasting and cable TV market. This puts Den Networks, one of India's leading cable TV distribution companies, as a strong competitor in the list of most sought-after undervalued small-cap stocks for 2022 to have in your kitty. Established in 2007 and spearheaded by a seasoned management team, Den Networks is a company poised for long-term growth. With an active expansion plan in place, the company diversified into providing all India internet service provider for broadband internet services. It currently operates across 500 plus cities and towns across 13 states in the country. Strong support from the parent company enabled Den to focus on the next frontier of growth areas. This included regional content creation for Tier 2 and Tier 3 markets. The goal was to be able to bridge the current demand-supply gap in these regional markets, resulting in this positive growth trajectory. Den Networks currently has a market capitalization of 17.4 billion rupees, with its shares trading at rupees 37 apiece. The price to earnings stand at a low 9.3, whereas the price to book value ratio is only 0.6, well below the M&E industry benchmarks. In financial year 2022, it recorded a profit after tax of 171 crore rupees on total revenues of 1,347 crores. On the back of a strong balance sheet, Den Networks had reduced its gross debt from 213 crore in fiscal year 2020 to 0 in the financial year 2021. Even though the return on capital employed was low at 4.7% over the past 3 years, the company managed to maintain a healthy position with a current ratio of 6.21. Second on the list is another undervalued small cap stock from the media and entertainment industry. Established in 1923, SANDESH has a market cap of 5.6 billion rupees. The company is currently Gujarat's largest and most influential media house. The company initially started off as a Gujarati daily newspaper. It has subsequently forayed into various other branches of the media and entertainment industry, including television channels, magazines, OOH and digital media. Shares of SANDESH Limited are trading at around 730 levels with a PE of 7.2, which is well below the 3-year average industry PE ratio of 15.8 and a price to book ratio of just 0.6. As of March 2022, the company's promoter holding remains unchanged at 74.8%, which has given the company direction to make its digital footprint more robust. The company also improved its EBITDA from 82 billion rupees to 123 billion rupees in the financial year 2021, by improving its return out of treasury operations. Currently, SANDESH has little to no debt on its books and has maintained a healthy liquidity position. A strong financial risk profile marked by a comfortable capital structure indicates healthy profitability in the foreseeable future for the company. Profits jumped from 58 crores in 2020 to 89 crores in 2021, and for the 9 months period ended December 2021, the profits have been consistent as well, which has helped secure a place for SANDESH in our list of top 5 undervalued small cap stocks. A flagship company of the Man Group, Man Industries India Limited is one of India's leading manufacturers and exporters of large diameter carbon steel line pipes. Founded over 25 years ago, the company occupies a dominant position in the pipe segment. It's the approved vendor for major domestic and international oil and gas facilities. Man Industries continues to focus on leveraging its existing capabilities to drive overall growth for the organization. The company has set up new manufacturing facilities with cutting-edge technologies across the country to boost revenue in the fiscal year 2022. Man Industries has proactively focused on higher ticket value projects during 2022 and has also ventured outside of its core business activities by setting up a subsidiary company in real estate. Now, global demand for steel pipes is on the rise, and the industry is expected to hit a CAGR of 6.2% by 2027. Domestic demand is also rebounding, with the Government of India announcing the expansion of the natural gas grid from 18,000 kilometers to 34,500 kilometers. Now, Man Industries has a current market cap of 4.7 billion rupees. The PE stands at 4.7 and the price to book ratio is hovering at around 0.5. Both are much below the industry average of 31.5 and 2.9 respectively. The shares are currently trading at levels close to Rs 80. Man Industries has increased its cash flow in the financial year 2021. The company also recorded an 18.9% revenue growth in the financial year 2021, despite the ongoing challenges posed by the pandemic. The earnings before interest, taxes, depreciation and amortization shows a 27.8% increase year-on-year, while the PAT recorded an 81.7% jump as per the third quarter results in the financial year 2022. All of these are indicative of the fact that Man Industries has consistently maintained a healthy financial risk profile, which makes it a worthy entry in the list of top 5 undervalued small cap stocks to watch out for this year. The next entrant in the list of undervalued small cap stocks is GLOSTER Industries, a name that is synonymous with wind power generation in India. It's a wholly owned subsidiary of the 130-year-old GLOSTER Group, a company that has played a pivotal role in driving India's economic story. GLOSTER Industries was incorporated in 1978. Back in 2017, the earnings of GLOSTER Industries skyrocketed and the growth trajectory was nothing short of eye-catching. Since then, the company has been able to sustain through the ups and downs of the pandemic and has consistently been on the path to profitability. The company's shares trade at close to 1400 rupees. The company currently has a market cap of 13.6 billion rupees. The PE stands at 23.5, which is well below the industry average of 63. On the other hand, the price to book ratio is 0.7, which is also trailing the industry average of 2.3 for a trailing 12-month period. During fiscal 2021, the company's EBIT margins increased from 14% to 22% year-on-year. A high promoter holding of 72.6% indicates that the company will be managed in the interests of its shareholders. With the owner having an investment of nearly 12 billion rupees in the company, they will be incentivized to build value in the long term for its stakeholders. In 2022, the company is virtually debt-free and boasts of a healthy liquidity position with a current ratio of over 64. This makes GLOSTER Industries an undervalued small cap stock that you must look at this year. The erstwhile Kettlewell Bullion and Company was rechristened as GLOSTER Limited and comes with a 140-year-old heritage in textile manufacturing. With an established presence in the jute industry, It is the last company to feature on our pick of undervalued small cap stocks in 2022. Promoted by the Bangur family, GLOSTER is listed on the BSE and currently has a market cap of 5.9 billion rupees. The share is trading at about 970 per share. In addition to jute manufacturing, GLOSTER has diversified its product portfolio into woven and non-woven jute geotextiles and is heavily engaged in the production of jute products for interior decoration and packaging of industrial and agricultural produce. To promote a sustainable alternative to plastic, GLOSTER entered into a MOU with the Telangana government for an investment of 3.3 billion rupees in the jute sector in September 2021. Needless to say, a high promoter holding of 72.6% instills confidence in the company and its prospects of future growth. The PE is hovering around 7, which is less than half of the industry average of 18.8. The price to book ratio stands at 0.5, whereas the industry average is around 6.6. The company is the market leader in the production and export of various types of jute and its allied products. GLOSTER has a healthy cash flow management with a PAT of Rs 73 crores as of 31st March 2022. This was a year-on-year growth of almost 66%. Despite the risks arising from the regulated nature of the jute industry, GLOSTER offers a strong financial profile that makes it an attractive investment proposition to investors looking to expand their portfolio into this segment. Small caps have had a great run over the past 2 years. The real question now is, will the party continue in 2022? Market experts think that the trend will spill over in 2022. That more or less makes your case for investing in undervalued small cap stocks this year. When the broader markets become cheap, like they were in March 2020, one should be greedy and look at undervalued and fundamentally strong small caps. However, given the volatile nature of small cap stocks, you must account for high risk with the prospect of high gains. In other words, be prepared for some wild swings. Here again, there is a way to beat volatility. Invest for the long term, and that will help you ride out any short-term market downturns. Also, if you stick around for longer, a small cap can potentially grow into a mid cap or even a large cap stock if the business performance is exceptional. Now all you need to do is spot and invest smartly in some really undervalued small cap stocks, and you may just end up picking the next Amazon at a steal. Wouldn't that be life-changing? And with that, we come to the end of this video. I hope you liked it and it helps. Thank you very much for watching. Happy investing. Goodbye.